Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio. This week, like we do from time to time, we want to step back a little bit as we're pretty well into 2021 and just discuss a little bit about some of the major macro reasons why precious metals, specifically a gold portfolio, does make sense in the modern era. So as we look at how the markets have moved, certainly over the last couple years, exaggerated through what happened with COVID last year, but this isn't new territory. COVID didn't start something. And I think it's important to go back and look at time and look at history and how this is something that's been building, waiting for the right catalyst to kick it off. And the kickoff I'm talking about is the substantial increase in money printing and inflation over the last year or two. So, Tori, I first want to ask you, being that we've been watching this inflation steadily and beginning to exponentially rise, the amount of money printing. I know we did a show specifically about money supply a couple weeks ago. So historically, Tori, and looking currently, just over the last couple years, what is the correlation between the price of gold and the rate of inflation?
Miles, that is question number one, really. When somebody's looking to diversify a portfolio and protect it, they're really looking at purchasing power preservation. So as far as purchasing power goes, if you just go back to 2000, gold has exhibited a consistently negative correlation to the currency purchasing power. So let's just take the US dollar. Inflation, your show from a couple weeks ago touched on the money supply issue. I like to compare that to the game of Monopoly. The richer everybody gets at the board, the more expensive all the properties become. The higher the rents become, the higher the sale price gets, the less passing go means to you, because the $200 just isn't going to carry the same amount of influence as it did at the start of the game. So that's sort of the money supply issue. The consumer price index is another one. So as you start to see prices climb, that's a decrease in the purchasing power of the dollar. So inflation can be sort of confused. So going back to the 2000 period, I'm going to bring Robert in on this because I know we were talking about some of the price action in gold, because what you just asked was, let's say, okay, going back the last year or two. I think going back 20 plus years is really the key. And even going back to 2008 when the economic crisis hit. And the reason that's important is because the Federal Reserve and the U.S. government, the U.S. Treasury, have shown that their modus operandi is going to be money, right? They're going to print money, they're going to create money, they're going to throw money at the problem, they're going to try to inflate, because the Great Depression was a deflationary depression. Don McIlvaney has said for decades, the next go-round, it's going to be all about an inflationary depression. So we know how they're going to approach it. Robert, just using gold as a barometer for this negative correlation to the currency purchasing power, let's start with the price action we've seen in the last 20 years.
Yeah, so if you back up 20 years, you had gold below $300 an ounce. And today, it's about 550% higher. If you annualize that over 20 years, that works out to about 27, 28% per year. Now let's turn to the S&P and look at the performance of the S&P over the last 20 years. About 20 years ago, it was 1290, 1300. Today, over 4,000. It's about 200 and something percent, 220, let's call it. Give it 220%. That annualizes to 10 to 11% a year. So in 20 years, gold has way outperformed the S&P 500. 27, 28% compared to 10 or 11%. Which one do you want to take?
Well, and the point you can take away from that as well is it's not only gold that's going to increase in its price in an inflationary environment. The stock market's going, you can go all the way back to the Weimar Republic and the destruction of the mark and see how their equities markets actually rallied. But guess what rallied tenfold over the equities markets? It was gold. And that's sort of what you're showing here is that, yes, consumer prices climb, stock prices climb, housing prices climb, but gold is what's going to make you immune. I like to compare it to a vaccine for the modern day word of the day, but it really does make you immune to the loss of purchasing power of the dollar. So the more they create, The more debt they create, the more they manipulate interest rates down, the better that outlook is for gold. So you have a zero to negative real rate, interest rate right now, other than what we've seen in the bond market here lately. But what's going to happen, especially in developed markets, there's going to be a sensitivity to the number of dollars in circulation. There's going to be a sensitivity to the velocity of that money. But far more important, you're going to have an increased sensitivity to interest rates during higher periods marked by heightened inflation. So that heightened inflation is what we're seeing now. And a really important part is that recently we've even seen a shock to the market with inflation rising above 4%. The Federal Reserve has a stated objective of 2 to 2.2% per year. All of a sudden, that starts to get out of control. You see something like a 4%, and what happens? Inflation-sensitive assets get rocked. So bond yields jump, stocks fall, especially growth stocks. What happens is that's the environment where gold will start to climb. And since the S&P 500 was created in 1957, Robert, as you're comparing to it, inflation has risen above 4% only 9 times. But over that period of time, it's a steady inflation. Over that period of time, that's why gold's gone from 50 to 2,050 per ounce. And in 8 of those 9 cases, stocks were lower 3 months later. Another important correlation is that gold tends to, in these high inflationary markets, it tends to trail other metals. So base metals, for example, will outperform gold for 6 months prior to gold really starting to turn around and catch. And then for 2 to 3 years after that rally, you see gold lead the charge. And that's why you have to be patient. When you're seeing inflation and you're not seeing the gold price respond immediately, hold on. It's still the hedge.
That's probably what we're seeing here with copper. Copper making huge returns here in the last few months and gold lagging. And I'd say, and I'd argue that gold's going to play catch up and outperform copper.
It totally will.
Yeah, Tori, and I think we saw an example of that back between like 2008 and 2011 market crash, where you start to see kind of a breaking of the more speculative assets. And as they began to fall, and we had the margin call situation, that actually did bring valuable commodities down along with it short term. But then as people got liquid and moved into safety assets, things like precious metals began climbing and hit pretty substantial highs within a couple years, whereas it took the equities market about 5 years just to recover. Now, I'm certainly not saying that in an inflationary situation, the other thing we could end up looking at is the Dow just keeps going up. And I think this is what, Robert, you were hinting at, is the idea that what if the Dow goes to 50 or 60,000 from here, but the cost of living increase that the average person is facing means that as the Dow's going up, it's less and less money going into investments and more money going into things like food and gasoline. So this is why when you look at the long-term growth of gold based on inflation over the last 20 years is drastically outperforming the long-term growth of the equities market, certainly the S&P, over the same period of time.
So that leads me to ask the question, why would you save in the form of cash? Robert, you brought up the point that we're seeing money market accounts now getting ready to officially turn negative, to where as interest rates stay manipulated low, that forms a negative real rate of return for your dollar. So that's another long-term reason to own the metals. There's inflation, and the Federal Reserve would like to say this inflation is transitory. Well, inflation in general is not transitory. Maybe a 4% rate, as measured the way they falsely measure it, is transitory. But over the course of the long term, inflation is like death and taxes. It's guaranteed. It's a stated objective. You have very, very, very few periods of time where there's actually a deflation or an increase in the purchasing power of the dollar, and it lasts for just a few months, not years. So all that to be said, the negative real rate of return means you can't invest your cash in a short-term yielding vehicle and expect to outperform inflation. If inflation is higher than the return you're getting on your dollar, that's a negative real rate of return. Anytime there's a negative real rate of return, that's very bullish for gold.
Well, that's why nobody's doing it. That was our money supply discussion the other week.
Right.
Nobody's invested in anything short term, except for the shortest term, of course, demand deposit accounts. immediately liquid, available, non-interest bearing cash. And that's where 95% of all cash is sitting in M1 Money Supply right now.
Well, yeah, if we jump back to that 20-year example, just looking at it over a longer term, for the first 10, if your financial advisor didn't recommend that you get into gold in 2001, 2002, you can't fault him for not being really early on a market move. But after 10 years, let's say 2010, 2011, if your financial advisor wasn't recommending a fairly nice position in gold, why not? And I'd ask yourself, why did your financial advisor not recommend a large position in gold 20 years ago, 10 years ago when the trend has started? Or better, when gold broke the sideways channel about 2 years ago and the chart turned bullish, why did your financial advisor not recommend that you take money and go to gold then? Because it's clearly turning bullish. Why do they not recommend a large position in it now? Well, is he or she clueless about the performance of gold versus the S&P? Over 20 years, gold's way outperforming the S&P. Or does she or he have a bias towards keeping your money under management rather than recommending you take a large percentage out from underneath management and just buy gold? Because if someone were to have just done this 20 years ago, written one check, bought physical gold, and held on to it, they outperformed the S&P, the market. And they didn't even have to, over that time, they didn't have to do anything. They didn't have to look at their quarterly statement. They didn't have to talk to their financial advisor when their financial advisor decided to call every quarter or every year if they're lucky. They didn't even have to go through any of those tasks. They just had to write one check, buy physical gold, and sit there. And they outperformed the market. That, I would argue, is going to be a winning strategy going forward for the next 20. Because if gold thrives on uncertainty and inflation, we just had a period of 20 years where maybe we had, 3 crises? We had 9/11, 2008 financial crisis, and then this COVID crisis. We have 3 crises. We've had 3 crises in 20 years. Do you think we're going to have more crises in the next 20? I would argue that you're going to have more uncertainty, more inflation, obviously. And so you could write one check to us today and buy physical gold and sit there. You don't even have to talk to us again. And I think you're going to outperform the S&P.
I would certainly prefer that my clients talk to me again, but maybe that's just me.
Well, though, they could just listen to the show and they could see what you're thinking every week.
That's true too, and they could go back and look at the same trend over 50 years. You still outperform the S&P over 50 years. So this isn't a convenient window that you're measuring against. And I think that it's important for people to understand, Miles, the point you brought up with cash in the bank. Yes, liquidity can be very important. Timeliness, opportunity. It should be short-term in its purpose, and it should be strictly for bill paying, because now you have bail-ins. Your money is not as secure, even with FDIC insurance. Sorry, but it's just not. And there's no ability to get a return on your dollar. So why in the world would you not make yourself immune to it and put yourself back on the gold standard and hold the majority of your savings that you're not looking for aggressive growth from? Hold the majority of your savings in tangible, physical, allocated ounces of gold.
A lot of people's arguments that we hear against buying physical gold is that you pay a premium to buy it. You have the spot price, and then to get the stuff in your hands, you're going to pay a premium to buy whatever you're buying physical. And that's a little bit of a hard thing for some people to swallow, is to pay a premium to buy physical gold. But even if you paid, 15, 20, 30, 50% premium to buy gold 20 years ago, you still outperform the market. And there are plenty of arguments in this day and age that you should have something outside the financial system that's in your hand. You don't have to trust anybody. You don't have to be dependent on anything. You have real wealth. So we can get into more of those details as this year goes forward, but I think the argument's been made. Gold's outperformed percentage-wise, plus the argument of inflation coming. I think it's a layup.
So that's going to do it this week for Golden Rule Radio. We appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, head on over to our website at McElvaney.com. You can also find us on Twitter at ICA Gold or Facebook at McElvaney Financial. As always, if you'd like to discuss your personal precious metals portfolio with one of the advisors here at McElvaney ICA, you can give us a call at 1-800-525-9556. Thanks for listening and have a great week.